Coming to this year's budget, I would refer it as curate's egg. You know, curate's egg is something which is good in parts. So if you see purely from an Aam Aadmi point of view, there is hardly anything. Hardly anything for an Aam Aadmi. So experts feel that at least they could have increased the ATG deduction limit, or maybe the standard deduction, or they could have at least increased the ATC limit, but they haven't done any such thing. So an Aam Aadmi is entitled to be a little disappointed. But when you see from perspective of the entire country, when you have a holistic view, this budget is decent because this is framed keeping the next 25 years in view. So they have called this Amrit Kaal. So they have kept a lot of trust. They have focused a lot on infrastructure development. A lot of cap expenditure is proposed to be made, basically to resurrect the economy. The economy was badly hit during COVID-19. So basically they want to resurrect the economy, and it's a welcome step. And I also welcome another thing that they have rationalized the trust provisions. There are so many amendments, and if I were to talk about it, probably we'll have to conduct another session for that. So I'm keeping it away from this. Just for a brief introduction, I would just say that there are two regimes of trust. And there are certain provisions which are applicable for first regime, not applicable to the second, and vice versa. And during this budget, they have rationalized this, and it's a welcome step, definitely. So, if you were to ask my opinion, my verdict on this budget, I would say it's too early because, like I said, it is proposed taking the next 25 years in view. So, it's too early to, come to a conclusion whether it is a victory or a loss. Coming to the highlights, I guess among all those things that are included in the budget, two things came into prominence. One is virtual digital asset, and another is updated return. I guess majority of the people are interested with these two things. So let's get started with virtual digital asset. One of the most pertinent thing in this is, we understand virtual digital asset as a cryptocurrency, but if you find that they have not used this term cryptocurrency anywhere, they just kept saying virtual digital asset. Virtual digital asset could be any number, any token which is produced with crypto technology, that they have included under the definition of virtual digital asset. And Nirmala Sitharaman, she is very categorical, and she says that this is not currency. How can you call this a currency? Because RBI has not issued it. What do you call a currency? Something which is issued by RBI. This is not issued by RBI. So don't call this cryptocurrency. Call it crypto asset, call it crypto security, call it crypto whatever, but don't call this cryptocurrency. And RBI is going to come up with its own version of virtual digital asset. This is something that she has made clear. Another thing we were just discussing, government has also made it clear that don't be under the impression that just because we have told you how to tax the virtual digital asset, that doesn't mean that we are legalizing it. We are not giving any legal credence to it. There is always this uncertainty hovering over the legality of it. People were under the impression that now that they told how to tax this income, so probably they have legalized it. No, they have said that it is not yet legal. We are not talking about it at all. We have only told how to tax the income under virtual digital asset. You must have seen that under section 115 DBH, the income under virtual digital asset shall be taxed at the rate of 30%. You all must have seen that. But under which head? This question is directed at people who are not tax professionals, because I understand that tax professionals know the technicality of it. Any idea under which head it will be taxed?
Other income from other sources.
Yes, very good, thank you. You must all be aware that there are 5 heads of income: salary, house property, profits and gains from business or profession, in a short term we call it PGBP, capital gain, and income from other sources. And let us understand the technicality behind taxing it under income from other sources. Basically, had they seen this as an asset, they would have amended the definition of capital asset. They have not done that. Basically, capital asset is like any property under this act, whether movable or not, whether connected with business or not, whether tangible or not, except stock in trade, rural agricultural land in India, personal effects, gold deposit bonds. They have excluded only these things, but everything else is capital asset. And had they seen this as a capital asset, they would also have told when do we consider this a short-term capital asset, when do we consider this a long-term capital asset. They have not done any such thing. That means they don't envisage this as a capital asset. Okay? That means if it is not a capital asset, then income from this capital asset, the transfer of capital asset is not capital gain. This is not supposed to be taxed under capital gain head. So, not supposed to be taxed under salary. It's not salary. It's not house property. It's not PGBP. It's not capital gain. What else are we left with? Income from other sources. So, income from other sources is a residuary source of income. Any income which is not taxed under any of the four heads, that will be taxed under income from other sources. So now it is clear that it will be taxed under income from other sources. Okay. Now they have also thrust a responsibility on the payer of the consideration. They said that under 115 BBH, the income will be taxed at 30% and no other deduction will be allowed apart from the cost of acquisition. The only thing that you can deduct from the consideration is just cost of acquisition. No other set off, no other deduction is going to be allowed. They have also thrust a responsibility on the payer of the consideration. They say that under 194S, there is a proposed section 194S for TDS. They said that the payer of the amount is supposed to make a TDS of 1% if the amount exceeds 10,000 in normal cases. When the amount exceeds 10,000, the payer has to make a TDS of 1%. And in case of specified persons, if the payer happens to be a specified person, the TDS provisions will be triggered if the amount exceeds 50,000. I welcome my chairman of Benefit Branch. Thank you so much, sir. So, I was talking about specified person. So, when the payer is a specified person, he will make a TDS of 1% only if the amount exceeds 50,000. When these people make a payment for this VTA, they will have to make TDS of 1% only if the amount exceeds 50,000. In all other cases, TDS provisions will be triggered if the amount exceeds 10,000. Okay. They have also said that the loss under VTA is not supposed to be set off and we can't carry it forward either. In case of income from other sources, anyway the loss is not supposed to be carried forward. So carry forward loss is not allowed, that is fine. They have also said that you can't set off this loss. And here there is a grey area. They should have given us a clarification with regard to one thing. Suppose you have two VDA transactions, transaction A and transaction B. You have income under VDA transaction A and you have loss under VDA transaction B. Can we set off both? Why does this question arise? Because in case of casual income is like lottery, betting, winnings from horse races, card game, puzzle and all this. Income from one source can't be used to set off the loss under another source. So if you have lottery income, you have card game loss, you can't set off one against the other. That is why this question arises, that if we have a VDA transaction A income, VDA transaction B loss, whether we are supposed to set it off against one another, they have not clarified it. We can also take the more beneficial view that okay, since they have not said anything, let us go total income wise, let us not go transaction wise. That's also a view that we can take if they don't come out with any clarifications. And actually our institute has proposed to clarify this matter. Okay. Now that we have understood the head under which they will be taxed, the TDS provisions, we'll also understand if VTA is received as a gift, how it will be taxed. I just mentioned that they have not included this under the capital asset definition, but what they have done, they have included this in the definition of movable property as envisaged in section 56. Before talking about that, I'll just explain the gift taxation. So if you receive cash gift in excess of 50,000 from a non-relative in a financial year, the entire amount shall be taxed. When you receive cash gift from a non-relative in a financial year exceeding 50,000, entire amount will be taxed. Suppose you get 10,000, 15,000, 30,000 in a financial year from a non-relative. This adds up to 55,000. So entire 50,000 will be taxed in case of cash gift.
This is non-related.
Yes, non-related. In case of movable property, You must be feeling that anything other than land building, virtually everything else is movable. But as far as Section 56 is concerned, they have taken only certain items as movable property. They have excluded everything else. What are those things? Jewelry, painting, bullion, archaeological collection, drawings, shares and securities, any work of art and sculptures. Only these things are under the purview of movable property. And when you receive any of these things as gift from a non-relative, only then the gift vouchers will be attracted, otherwise it won't be attracted. Suppose you get an Audi car as a gift from a non-relative. Car is not there among the things that I have just told. Car is movable property. But car is not there among the items that I have just mentioned. So gift vouchers won't be attracted. It's another matter that which non-relative will give you an Audi car as a gift. It's another matter. But just for sake of clarification, I am just telling that only these things are considered as movable property as far as Section 56. When you get any of these things as gift, only then the gift vouchers will be attracted, otherwise not attracted. They have said that the property as far as Section 56 is concerned includes this virtual digital asset also. They have included this virtual digital asset in the definition of Section 56. So that means when you get a virtual digital asset as a gift from a non-relative and the fair market value exceeds 50,000, then the gift vouchers will be attracted. Just in case of other movable property, same gift vouchers will be attracted in case of virtual digital asset also. I guess I have covered all the relevant provisions with regard to VDA. Now let's move on to Section 43B. Before explaining that, I just said, you must have seen in the trading P&L, your accountant must be writing audit fee payable in P&L and also in the liability side of the balance sheet. That means it's an expense outstanding. You can claim it on accrual basis, on due basis. Even if you have not paid it, you can still claim it. But Section 43B has restricted certain items. It says that these things you can claim only on cash basis, not on accrual basis. If you are not paid, you can't claim. What are those things? Bonus to employees. Any contribution to be made by the employer with regard to employee like EPF or other employee development fund, taxes, duties, etc. and interest paid to financial institutions, state financial corporations, scheduled banks, all this stuff. So these are the things you can claim only on cash basis. Even if you have missed the due date, at least if you pay these things by the due date of filing of return, you will be allowed. If you have not done that, then you can't claim on accrual basis. You will be allowed it only when you make the payment. That's what Section 43B says. So now why did I mention this? What certain companies used to do, they used to have huge interest payable. What they used to do, they used to convert this interest payable into debentures. And they were claiming it as 43B, as an expenditure. But this budget has clarified that you can't do it. Whether you continue to show it as interest payable or you convert it into debenture, the fact remains that you are not paid it. If you are not paid it, then you can claim it under Section 43B. This is something that they have clarified. There is another thing with regard to perquisites. Before talking about perquisites in case of salary, since we are talking from a business perspective, let's continue with that. You all must be giving or getting certain perquisites, certain gifts from your network partners, like a free foreign trip or some such thing. You must be giving some gifts in kinds as an encouragement or some such thing. Now, section has been included, proposed to be included, that is Section 194R. It says that when you give such gifts to your network partner and the amount exceeds 20,000, then the payer has to make a TDS of 10%. I repeat, when you give such gifts to your network partner and the amount exceeds 20,000, then the payer, whoever is paying, has to make a TDS of 10%. These things can be given in cash, can be given in kind. So whatever manner you give, if the amount exceeds 20,000, then the TDS provisions will be attracted, and the responsibility lies on the person who gives to collect the TDS. If it is in kind, people ask, or if it is partly in cash, partly in kind, how to make the TDS. They have said that it is your responsibility. How do you do it? It's your responsibility. Ensure that the TDS is deposited, only then you have to release the consideration. That they have told. Now coming to the COVID relief thing. When an employer, pays this non-monetary benefits to the employees, all such things are covered under salary. Salary is not just about the basic thing, it includes a lot of allowances, it includes a lot of perquisites also. There are different methods of valuing those perquisites. But there is a thing, like if an employer puts the medical bill of the employee, when he gets the treatment, the employee or any one of his family members get treatment in a hospital owned or maintained by the employer, in a government hospital, or in a hospital meant for specified disease. When an employee or any of his family member gets treatment under any of these hospitals and employer puts the bill, it is not covered under perquisite, it is exempt. So they have increased that. They said that if employer gives this some amount to the employee for COVID treatment of the employee himself or any one of his family member, that amount also won't be taxed as a perquisite. So they have just extended it. Initially it was like when the employee or any one of his family members gets treatment in the hospital owned or maintained by the employee, in a government hospital or hospital for specified disease, only in those cases it used to be exempt. Now they have said that if employer makes some payment to the employee for COVID treatment of the employee or any one of his family members, again it won't be taxed, it won't be considered as a perquisite. What if a person dies due to COVID-19? If an employer pays the amount, the entire amount is exempt. A person dies due to COVID-19, his family gets ex gratia from the employer, entire amount is exempt. But if the same amount is received from some other person, not by employer, not from employer, some other person has given this payment to the family of the deceased who died due to COVID-19, there is a limit of 10 lakhs. As long as the amount received by the family of the deceased who died due to COVID-19, as long as the amount is up to 10 lakhs, it is exempt. Once it crosses 10 lakhs, what happens, they are again not clarified. This is again a grey area. Somehow I feel that there is a deliberate attempt on the part of the government to be a little vague. They said that when this amount is received from someone other than employer, it is exempt up to 10 lakhs. But they are not told what if the amount is more than 10 lakhs. So suppose a family of a deceased who died due to COVID-19 gets an amount of 15 lakhs. Whether we will tax the entire 15 lakhs or will tax only the 5 lakhs, they have not told. This is another clarification that they should be giving us. Now moving on, let's talk about updated return. Probably all of you are interested in knowing that. When we had this panel discussion at Rotary, Uncle asked, Vivian and sir asked, what's the difference between the existing revised return and this updated return? First and foremost, the difference lies in the section, basically. Section is 139.5 revised return and this proposed section is 139.8a. Okay? And then the time limit. Currently, the time limit for making a revised return is 3 months before the end of the relevant assessment year. The time limit for making a revised return is 3 months before the end of the relevant assessment year. That makes it 31st December. So suppose the same time limit also applies to 139.4 belated return also. Suppose you missed your deadline. So deadline could be 31st July, could be 31st October or 30th November. 31st July for non-audit cases, 31st October for audit cases, 30th November for those who have transfer pricing, international transaction. So suppose you missed the deadline. So the time limit by which you can file a revised return is 31st December. So suppose the time limit applicable to you is 31st October and the time limit for making a revised return is only 31st December. That means you have only 2 months to revise the return. So that was too harsh. So if 30th November is applicable to you, that means you have only 1 month to revise your return. That also is a little harsh. And this is an amendment proposed by our institute, ICA, and our experts were saying that they proposed it and they are glad that the authorities have included that. They said that why don't you give a chance to an honest taxpayer? Why are you curtailing the time limit for making a revised return to such an extent? Actually, initially it used to be 2 years from the end of relevant assessment year. That got reduced to 1 year from the end of assessment year. That got reduced to end of relevant assessment year. Now it is 3 months before the relevant assessment year. They are going on curtailing the time limit for revising the return. Our institute said that if there is an honest taxpayer, he has missed this deadline. No, he could not file it even by 31st December. He wants to pay the tax, he wants to file the return. Why don't you give a chance? Why do you kind of wait for a reassessment and subject him to proceedings and all that? He is interested in paying, but it is वो मना तो नहीं कर रहा है ना, वो तो चाहता है कि रिटर्न फाइल करने के लिए और टैक्स देने के लिए. आप just because उसने टाइम लिमिट मिस किया, आप उसे चांस नहीं दे रहे हो, ये गलत है. So that is why they came up with this updated return concept. So the time limit for updated return is 2 years from the end of the relevant assessment year. This is proposed to be applicable from 1st April 22. That means financial year 22-23. Relevant assessment year will be 23-24. So the time limit is 2 years from the end of the relevant assessment year. That means 31st March 26. Okay, that is what is proposed. Another difference is, in case of revised return, you can revise it any number of times till the time limit. Time limit is 3 months before the end of relevant assessment year. You can revise it any number of times before the time limit or before the assessment gets over, whichever is earliest. The time limit is 31st December. So suppose you have already filed a return under 139 original return, you have filed by due date. Or you have filed a belated return, then you suddenly remember that, oh, I forgot to claim this deduction, oh, I should have included this. You can revise any number of times, but you have to ensure that the time limit has not expired or the assessment is not yet over. But in case of updated return, you can file only one updated return. The question of going on filing different updated return is not there. That they have clarified. In case of normal revised return, some refund to be claimed, there is some decrease in liability, all these things you can claim. But in updated return, it is applicable only if some additional tax is to be paid. They have said that once you file this updated return, you have to furnish the proof of tax payment under section 140B. That they have said. So that means that only if there is an additional tax liability to be paid, only then you are supposed to file the updated return. If you want to claim some refund or some increase in refund, if there is a decrease in your income tax liability, then you are not supposed to file that updated return. They have also said that search provisions have been initiated or some survey provision has been initiated, some assessment, reassessment, some proceedings are going to be made, are completed or about to be made, or the assessing officer has some information, some incriminating information against you, then also you can't file an updated return. So they have put all these restrictions, and prosecution is going on against you, then in that case also you are not supposed to file an updated return. So these are the basic differences between normal revised return and this updated return. Okay?
Increase your profit, but you can't decrease.
Yes. They are welcoming only those people who are willing to pay some additional taxes, not the people who want to claim some refund. If you forgot claiming your refund, then well, nothing can be done about it right now. So only if you want to pay additional taxes.
That is why they have not used the word revised return. They have updated the return.
Yes.
Yes,
Yeah, very good question. I was about to come to that. Again, we'll understand the provision. They said that this also is a pertinent thing. People ask, you are saying that you can't claim you can't file an updated return when there is a decrease in liability, there is a claim of refund, or there is an increase of refund. In case of nil return, these things are not applicable. So there is a chance of people interpreting it as, even though you are supposed to file a nil return, you can file. But you again go back to this provision. This says that you can file an updated return under 139(8)(a) only when you submit the proof of having paid the tax under 140(b). In case of nil return, question of paying further tax doesn't arise. So that means person who is supposed to make a nil return can't make an updated return. Only in case of additional taxes when he is supposed to.
Yes. Permanent change to voluntary disclosure scheme.
Yes. That's how that no one is going to come forward to make any voluntary disclosure.
but they say we have not sent the balance.
It's an open secret, right? So that's the thing actually. These are the basic differences between revised return under 139(5) and updated return under 139(8)(a). They may also include some other provisions also. They also leave this draft open for them, as may be prescribed, as may be notified. So they just keep all options open to include as many things that are that can be included. Apart from this, anything else you want to know? I mean, these are the relevant things.
This COVID provisions you said, do they relate to the deaths and payments and treatment expenses during the financial year 22-23 or the earlier expenses?
They-
Because this budget is for 22-23.
They have made it retrospective, retrospective. That's why this budget is little different in the sense that there are certain prospective amendments, there are certain retrospective amendments. So that's about it.
Otherwise, it would be, assuming that COVID will continue in 22 and 23 also.
But the provision should be there.
Yeah, but when there are more number of cases, the province will be useful. If there are no cases,
Nobody can claim it as well.
Okay, moving on. Section 80 CCD deduction.
Hello.
Initially, what used to happen? The limit on employer's contribution was restricted to 14% of salary in case of central government employee only. You know, you have to understand the definition of salary very well, because the definition of salary keeps changing in the entire chapter of salary. The definition of salary is different for different purposes. So as far as this thing is concerned, the definition of salary here is basic plus dearness allowance, which is given as per the terms of the employment. That is the definition of salary here. And the limit for employee's contribution is 14% of salary in case of central government employee. Then they felt that why are we discriminating between the central government and state government employee? Let us make this available to state government employee also. They have brought some parity, they have rationalized it. So both are on the level playing field. So even in case of state government employee, the limit on employer's contribution is 14% of the salary. ATD, like we were expecting some increase in that because of COVID-19, but D became disappointment. Nothing, the limit has not been increased. But ATD, they said that initially the existing provision is such that, say if there is a person, an individual at HUF has a dependent who is disabled. The term disabled sounds a little harsh, differently abled, or some terminology would have been better, but the provision says disabled. So if an individual at HUF has a dependent brother, sister, spouse, son, daughter, it is a person. And this person or this HUF has taken a policy for the benefit of this dependent. The amount will be paid only on the deduction will be allowed only if the payment is going to be made after the death of the person who has taken the policy. That is the existing provision. This individual or HUF has taken a policy, insurance policy, and if that amount is payable only on death of this person, only then the deduction was to be allowed. Then they again felt that okay, this is not proper, so now they have said that deduction will be available even if the amount will be receivable on this person's attaining of senior citizenship. Once the person who has taken the policy, once he attains 60 years and the amount is payable on he is attaining 60 years, only then the deduction will be allowable. That is what they have done. That also is a welcome step. 80 IAC startups, their deduction was supposed to be ended by 31st March 2022, but they could realize that many of them must not have even started their operations, so that is why they extended the deduction. Startups, they get 100% of profits deductions for any 3 years out of the first 10 years. So that would have ended by 31st March 2022, they have extended it to 31st March 2023. That also is a good step. All in all, I think, like I said in the beginning of my address, that they have focused a lot on the capital expenditure on infrastructure building. So that is something that we have to welcome. So once the infrastructure develops, like I said, there will be employment generation, which will result in income generation too. Hopefully, economy will be revived. I guess it is going in a good direction. If the figures are anything to go by, if they are to be believed, then I think the economy is going in the right direction. Our finance minister sounded very optimistic. She said that we will definitely reach this target, if not, cross this target. So let us all try and help our government, and let's build an Atmanirbhar Bharat. Thank you so much for giving me this opportunity, and absolutely love this.
Can you highlight a little bit about PDS and PCS and payment of collection of PDS and payment of PDS? Is there any clarification in this matter?
No, not to my knowledge.
No. If you have a turnover of more than 50 lakhs, your turnover is PCS and TDS applications. Suppose somebody has taken TDS has been collected or TCS has been paid. Is there any clarification in this matter?
No.
It is there prevailing, same act is prevailing.
In case of this virtual tax, virtual digital asset
TDS will be there, but otherwise TCS.
So, yeah, I think it is in a way recognizing it as a legal aspect, isn't it?
So they want to keep all options open. If they want to tax it.
Suppose somebody takes a summary of 1 crore rupees for killing another person. It is not mentioned in income from other sources. And somebody takes some amount to kidnap somebody or abduct somebody, it is not mentioned in it. All these illegal activities are not mentioned. That means when you are saying that the consideration received by transferring virtual digital asset is taxable, that itself is an indication that you are recognizing it as a legal activity. And that becomes a legal asset.
They say it is not legal tender money.
Yeah, it's not legal
Not
tender
legal
money, that's
money.
okay.
That extent they say.
But they are accepting that it is an asset.
Again, as in,
Original gift tax plan has not been adopted.
No, that's been mentioned. They have just included this virtual digital asset also on the mobile side.
They wanted to recognize it but are hesitant because
RBI is going to come up with its version.